Good afternoon. My name's John Allotta. I'm a chartered accountant. I'm here with Sam Fenning, who's a wealth and investment advisor. We've put our heads together today and tried to offload some information to you which might help you with your planning processes from an investment and tax perspective. We'll start with the basic premise of capital gains tax. Capital gains tax is a tax on sale of an asset. Now, the government's got a very lenient policy here. They say if you hold an asset for more than 12 months, we will give you a 50% discount on your capital gain. That's a large discount. So if you're at the top marginal rate of tax plus Medicare levy, you're effectively paying 25 cents in the dollar tax on a capital gain. This becomes relevant when you start investing, and Sam obviously has many clients that have got money in portfolios, managed funds and foreign indexes where assets are held long term and they're not circulated or disposed of quickly. The difference between holding an asset long term and buying and selling assets all the time is that if you hold long term, you get that 50% discount. If you're turning assets over and selling and buying and selling and buying, you're crystallising your tax. You're not getting the 50% discount, so you're paying tax as you go, year by year. That comes in. Now, this principle comes into vogue. It's really relevant when we talk about any form of investment. It's the long-term strategy that applies here.
From our perspective, John, we see a lot of clients using more and more index funds. If you're not familiar, there's typically two kinds of investing. More active approach where trying to pick stocks and big companies that are hopefully going to outperform a particular benchmark, and the passive or index side, and that essentially is a range of stocks or shares or assets that effectively follow a particular benchmark or index, like the ASX 200, which is the top 200 companies in Australia. And what they do is they try to replicate that so that we're investing in the same way that benchmark works. So we'd be putting our money across, in this case, the top 200 companies in Australia. And the main reason for that is really easy access to diversification, the quite low cost, low turnover. Because of low turnover, there's typically a low amount of capital gains and taxation and trading costs going on in there compared to the more active approach, which has all of those issues. And I suppose from a capital gains perspective, as you mentioned, John, they're quite important when we're considering a longer term perspective and a longer term portfolio, perhaps something of 5+ years. Because they have that growth factor, and because we can get access to that capital gains discount of up to 50% of the net gain, these types of investments can often form part of the core of a client's portfolio, and I suppose are reasonably tax effective compared to other versions and other types of investing.
Anyway, thanks for having me over, and it's always good to talk to you about these issues and other issues.
Likewise, and thanks for having me. It was, I think it was great to be able to share a little bit of knowledge around different investing and the long-term investing style.
Yeah, it's good to get some real life cases going too, isn't it? We tend to get stuck into them.
Yeah, I always think it's good to make them as applicable and relevant to the audience as possible.
Yeah, definitely. It's a very personable business, so we're here and you're there, so come over and say good day.
Thanks for watching.